in anything that we do, even doing this podcast, right, you have to prepare. Preparation is everything, right? Even the minute thing that we do, we need to prepare before we do it, right? Similar with fundraising. And I'm really surprised that some founders don't see the importance of being prepared, meaning that diligently setting aside documents, information, your projections, all into one nicely stored in a data room, right? Because that will be very, very important, right? You do not want to make up things as you go along fundraising, right? There needs to be all those information stored somewhere where you can give access to your potential investor and for yourself to also then refer, right? And update as and when you go, right?
Welcome to the iSearch podcast. Today we have Sam Shafie, the co-founder of pitchIN on the show. Today I'll be discussing with Sam on how to raise funds for your business via Equity Crowdfunding, also known as ECF in Malaysia. So welcome to the show, Sam.
Hey, thanks, Ben, for having me.
All right, so let's begin. So let's start with the story of pitchIN. Like, how did the idea of pitchIN came about?
Right. Okay, so pitch is actually made up of two people, myself and Kashminder Singh, who is my co-founder. Today we have, I think, roughly around 36 people. So in 2012, when we first started, it was just me and Cash. Then we had Nurul, Henry, Nason, Saifuddin, and Jordan when we first started. That was way back in 2012. So the whole idea of how we started pitchIN, Ben, was really inspired by Kickstarter, right? I think a lot of people are quite familiar with Kickstarter, who I still consider, even today, the poster boy of crowdfunding. Having said that, Kickstarter only focuses on one kind of crowdfunding, which is reward crowdfunding. So they do reward crowdfunding, as you know, does not involve any shares giving out to people who support a company or a campaign. So we were really inspired by Kickstarter. But what's important, at least in the Malaysian context, in terms of how or why we started pitchIN, was that prior to starting pitchIN, Cash and I are also investors in company startups. So we invest through another company called Watchtower and Friends, or WTF Accelerator. So some of your listeners may be familiar with WTF. We actually were the first investors in companies like The Lorry, Money Match, My Cash Online, La Pasa, to name a few. So one thing which we realized, Ben, during that journey as an investor was that once we invest in a pre-seed company, and when the company started to grow, right, there was always that valley of death. And I'm not sure that you've seen that graphic, which is commonly used by a lot of people, describing a journey of a company. So after your pre-seed and seed, there is this valley of death before you try to raise your Series A, right? And that's where a lot of companies struggle to raise funding because they're still struggling to find validation. They need more time and need more money to actually validate whatever they're trying to do. So that's where a lot of companies die and fail. So when we look at what's happening around the world, especially at that time in the United Kingdom, in London itself, we saw two platforms, Seedrs and Crowdcube, that were actually a crowdfunding platform regulated in the UK that allowed companies, unlisted companies or privately held companies, to raise funding from the public. Yeah, and that's when we thought that this could potentially work in Malaysia to just address that funding gap between the seed round and the Series A. That's how we were inspired to actually set up pitchIN, and which led us to then later lobby the government, i.e. through the regulator, the Securities Commission, to allow equity crowdfunding to be to be used in Malaysia. Because offering shares publicly, as you know, is not allowed unless you are a public listed company. So privately held companies are not allowed to actually offer shares publicly.
Okay, so could you share with the audience like what is equity crowdfunding, and also like how is it different compared to the other source of funding like VC or angel?
Right, great question, Ben. Again, we get this a lot, right? Even after 8 years of running equity crowdfunding in Malaysia, because we started in 2016, so it's now 2024, but people still do have that question. So equity crowdfunding basically is a way for companies or founders to raise funding, but rather than raise your funding privately by speaking to an angel investor privately or a VC privately, you now can do it publicly, right? Which means that your investment opportunity is now made available to anyone, not just Malaysians, individual, not just Malaysian in terms of a company, but also all over the world. So we've actually seen people from all over the world coming to invest in companies who are fundraising on equity crowdfunding, not just on pitchIN, but also on other platforms that are licensed by the Securities Commission. So that essentially is equity crowdfunding, allowing companies who are privately held to be listed on a platform regulated by the Securities Commission, and investors from all over the world can come in to join and invest in this company. Now, how it differs, and again, I really don't like to use the word different from VC, Ben, because sometimes it denotes that you must choose one over the other. I've always felt from the beginning that equity crowdfunding can always be complementary to VCs and angel investors. Why I say this is because if a company were to fundraise on pitchIN, right? Say, for example, they want to raise 10 million ringgit. We at pitchIN could easily, depending on the suitability of the company, approach a VC and then, of course, also promote these companies to people all around the world. And you can see both parties, the crowd, made up of retail, angel, and sophisticated investors, co-investing together with a VC in this same company. So that's obviously is possible, and we've done that before, right? So that's why I don't really see us as choose one or the other, but you could actually use us to bring in all different investors into your company.
Right. So they will get like access to retail investors and also VCs and also some angels
right.
via your platform. Okay.
One thing interesting about equity crowdfunding and also just fundraising generally, Ben, is this. So if you were to raise funding from a VC or angel investor, so you have one investor and you then engage only with this one person, right? But if your company could raise money from members of the public, especially people who are already using your product, they clearly love your product, right? And they use your product. The fact that they're investing in you shows that they really, really like you, right? And not only that, right? Now they become an investor, and now suddenly they become marketeers or evangelists for your company, right? So now they will probably introduce your product, your services to other people, their friends, their family members, right? So by onboarding some of these investors, and we've seen this happening in some of the companies that fundraise on pitchIN, where the investors are now acting as marketeers or evangelizers for what we call the business themselves, right? So not only do you get money from your investors, but these people will actively go out there and promote you.
So for companies that wish to raise funds via ECF or equity crowdfunding, would it be better for them to be slightly more established first? Means that they probably like have a certain group of customers rather than they are like a pure startup and they go for ECF. Would they need to be like maybe, let's say, 2 or 3 years into the business, then only they start to do ECF?
Yeah, great question. Again, that's also another common question that we receive, and by you asking that, hopefully those who listen later on will know the answer to it, right? So you'll be surprised, Ben, that we have at pitchIN have done actually 4 companies out of the 177 that we've done thus far, where those companies that came on pitchIN came in with just a PowerPoint deck, right? So they had no business at all yet, not even the product, right? Which means they were very, very early into their business, right? With just an idea. Now, what set them apart from other founders is that despite the disadvantage of not having an actual business thus far, right? I think they managed to actually clearly lay down what they're trying to build, clearly lay down how much money they need to do this, how they're going to do it, and also their past experiences in terms of building companies, right? So that had allowed them, despite not having a business running so far at that time to manage to raise funding. In fact, the largest ever fundraising that we did for a company with just a PowerPoint deck was 1.5 million ringgit, just based on the PowerPoint deck. So to answer your question again, you don't need to. Having said that, it is generally expected that you do have a business for you to show investors in terms of your track record, what have you done thus far, and how you can then grow your company to the next level, right? So that's why I wouldn't say it's the norm, but then always in everything, Ben, as you can expect, there will always be an exception to the general rule. So while we, as you can imagine, we love to actually list companies who already are in the market, already doing revenue, hopefully profitable, right? With a clear strategy in terms of doing very, very well. But we do come across some founders who, after speaking to them, even my team and I feel that I want to invest in you, even just an idea company, right? So it's not necessarily what we will still look at, even though you're an idea stage company too. That's something that we also would look at. Yeah.
Right. So in terms of like the best practice before they do ECF, what is like the do's and don'ts?
Right. I think, Ben, in anything that we do, even during this podcast, right, you have to prepare. Preparation is everything, right? Even the minute thing that we do, we need to prepare before we do it, right? Similar with fundraising. And I'm really surprised that some founders don't see the importance of being prepared, meaning that diligently setting aside documents, information, your projections, all into one nicely stored in a data room, right? Because that will be very, very important, right? You do not want to make up things as you go along fundraising, right? There needs to be all those information stored somewhere where you can give access to your potential investor and for yourself to also then refer, right? And update as and when you go, right? So I know it sounds cliche, it sounds very, very basic, but having done this for the last 8 years, I'm surprised that some people are just not prepared, right? So preparation is number one. The second thing, Ben, is really knowing where you are at your stage and the people or the kind of investors that you need to speak to at your stage, right? So if you're an early stage company, right, meeting top VCs is probably a waste of time, to make it bluntly, right? Maybe it's not, because you can probably build some bridges so that later when you want to fundraise, you can then, when you want to fundraise at the higher stage, maybe you can connect to them. But then when you're still early stage, you want to be very focused in terms of who you are speaking to, because you don't want to prolong this fundraising exercise, because fundraising itself, Ben, can be very, very tiring, right? I think all founders like you and I, we want to get back to what we are supposed to do, which is to build and run a company, right? Fundraising takes away of our attention to what's very, very important, i.e. our business. So when you're fundraising, you need to know who are your investors, right? So you need to know investor A would not probably invest in you. They're probably looking at much more later stage companies. So leave them aside and just focus on those people who are within the stage of your company. That's something which, again, time and time, we see founders losing sense in terms of who they should speak to, right? So sometimes we see that people will just spray their deck everywhere, right? Sometimes resulting in their deck being in someone's inbox belonging to a VC, which normally would not even look at your deck because you're still far, far early into the company, right? So knowing your investors, the stage of this particular investors is, again, very, very important. So that's another do that they need to do, right? The third one, Ben, is really what every investors, be it retail, angel, sophisticated, VCs, is really about valuing your company, right? You need to know and justify the valuation of your company. If you don't, it's important that you get assistance for you to then be able to justify why you are valuing your company at so and so amount. So I think those are the three main things, Ben. Just to start with, right? Preparing, knowing who you speak to, and also even before you speak to investors, right? Having a sense of what potentially your company is valued at. You don't want to overvalue, neither do you want to undervalue your company, right? What you need to do is to balance the expectation of the investors and also for yourself.
So I think this is a tough question. So in terms of valuation, because
Yeah,
I would assume that most founders that start their company don't have much of a accounting background or this type of due
yeah,
diligence, those type of things,
yeah,
right? So how do they
that's right.
value their company? How do they know how
Yeah,
much is their company worth? Especially if they don't have any revenue yet or their
precisely
company
right.
is not profitable yet.
Precisely right. Yeah. So okay. So there is one way, Ben. Right now, before we dive into the question about valuation, right? So right now there are several ways for us to fundraise, right? Right now, what's popular that I see happening within the local ecosystem is that people will actually offer safe notes, right? So safe note is a situation where you actually pause the valuation of your company until the next round, right? So because at that particular first round, you probably don't know what really your valuation is. You're still early. Investors also do not know really how to value your company. So both parties agree, let's suspend that valuation. We do a safe note. I give you money, then you build your company. At the next round, then we will then find that valuation, right? Because by that time you would have your numbers and so forth,
Yeah.
right? Um, Now, unfortunately, Ben, safe notes for now is not accepted on equity crowdfunding,
Mm.
right? It will hopefully. Regulators are looking at it. So hopefully soon regulators will allow companies to offer safe notes when they raise funding on equity crowdfunding. Yeah. Okay. So put aside safe notes because that's an option for people if they don't know how to value the company at that time. They could offer safe notes to investors, and typically investors will agree and they will suspend that valuation until the next round when you are ready to fundraise again, right? Okay, so that's the safe
Right.
note. Now, with regards to equity crowdfunding and your question about how do founders value their company, right? So this is typically what will happen then. And again, I don't fault founders. We're founders ourselves. We have a different mindset in terms of what we need and what we want to give to people in terms of equity, right? So typically, right, this is what will happen, right? We as a founders looking at the company and looking at what we need in terms of growing the company, we know that we probably need 1 million. So off the bat, I need 1 million ringgit for my next growth, right? Because I need to spend this money to do X, Y, Z, right? Then I would then think, right, so how much equity should I give away, right? So typically, and this is something which I see quite a lot, right, when companies come to see us to raise funding, founders will typically say that, you know what, I don't want to give a lot, and maybe 10% sounds just nice, not too much, neither is too little, but just nice because you know what, probably I will probably need to raise another one more round or two more rounds. So by not giving too much equity in the early stage, I will then hold a lot more which later I can give out for my other fundraising round. Yeah? But then if you're an early stage company, right, where revenue is still very small, right, by telling me that you want to raise 1 million and offer 10% equity to investors, right, you are now already telling me that you're a 10 million ringgit valued company, right? So 9 million ringgit pre-money and 10 million ringgit after you fundraise post-money, right? So normally, Ben, we would not say anything in the beginning, right? Because again, I just want to understand how the founders think in terms of the amount of equity they want to give away and also what we call the valuation, right? So we really suspend that discussion on valuation for now until we get more information in terms of their revenue, their profit and loss, and see where they are, and also request from them their projection, right? So normally a 3 to 5 years projection, right? So normally, if the numbers are good, and based on the vertical or sector where they are in, and we typically see, for example, if you're a SaaS company, right, where the multiples are what, 20, 30 multiples. And then when we look at your company, and based on what we see outside, potentially what you're asking for may be justified, right? But if it's not justified, right, then that's where we will then have that hard discussion about justifying what we feel would be something that investors would be happy to take on, as against what the founder is also comfortable to giving out. So there's always this dance, right, around this, right, where we need to find a sweet spot where both parties will be happy to do business, right? Because if it's too high and investors feel that it's not justified, neither do they see that there is great evidence or proof that even if I give you money, you'll be able to actually do what you think you can do, then it's difficult for the investors to have their mind to agree to the valuation that you need. Plus, we always caution investors that, caution founders that be careful with valuation, because you may be able to persuade investors to agree to your valuation. But in 12 months or 18 months, after you use up all the money, and when you need to raise another round, and you can't meet all the numbers that you actually projected in your last round, that's going to be very, very painful for you, right? The worst thing that could happen, there'll be a down round, right? But then the other flip side is that the company may even have to close down if no one wants to invest, even on a down round, right? So we always advise founders to, if you're not able to justify it, because you know what, once you stick on an amount, investors will actually hammer you left, right, and center, right? Just to understand how you value your company, and that's why we feel that if you're too biased, right? Because all of us are founders, obviously we are biased to what we want, right? We always ask them to get a third party, right? So at pitchIN, we're not supposed to advise companies on valuation. So hands off, we're just a platform. We would give feedback, but we're not supposed to actually dictate your valuation, right? So either you bring in a third party that you know that could help you to justify it, or we have someone, a list of valuation companies that could help you to get to that justification of the valuation that you need before you meet any investors. I can tell you, Ben, valuation is probably the first thing any investors look at, even before they dive into the company, right? The first thing they ask is how much they're raising, how much equity they want to give away. All right, now you're telling me you're valued at X amount of money. All right, so tell me now about your business. But then when you tell them, we just started last month, then you're asking for 10 million, you're going to be crazy, right? Yeah.
Got it. So, like, on average, like on pitchIN, like how much equity does founders give up? Is it 10%, 20%, or what's the range?
So it depends, Ben. I think the more mature you are as a company, meaning that you've gone through the early rounds of the pre-seed, seed, and so forth, right? You'll probably see less equity giving away because they've actually weathered through those storm during the early days, so they validated to some point, they're now growing, so they could demand a higher valuation, right? So which means the equity which they give away could probably be between 10 to 15. In fact, we've seen one or two companies offering even below 5%, right? But for early stage company, that's where the difficulty with the founder, right? So I'm very early, I need 1 million, but I don't want to give away more than 10%, right? But you're so early, your revenue is probably very, very minimal, right? And there's no way the numbers can justify the valuation, right? And hence what you're doing is that you're just future projecting your companies, hoping that the investors will buy into your future projection, right? But then projection, as you know, Ben, most of the time is BS, right? If you and I can tell the future, we won't be sitting here talking on the podcast. We'll probably be laying around in an island somewhere, right? So we know projections are BS. That's the best case scenario. But then once you take money, you don't know what's going to happen in the future, and so forth, right? So if it's an early stage company, you expect to see founders giving away even up to 30% of their company, right?
Okay.
Yeah. So we've not seen anything, any company or any founder offering more than 30% of the company to investors on the platform.
So,
Yeah.
okay, let's put an example. So let's say if the
Sure.
founder give away 10% of their
Yep.
company via ECF, and
Yep.
let's say there's 200 people, 200
Mm.
investors that invest. So does it mean that each investor owns 0.05% of the company? Is it something like this?
Yeah, so if every investor invests the same amount of money, then you probably see that, right? But
Right.
as you know, some people can come in with just the bare minimum of what is asked for. So, for example, a company comes in, they want to raise 1 million for 10%, and the minimum investment which they allow people to come in is, say, for example, 1,000 ringgit, right? So if 100, so okay, my math is very bad, right? So if 1,000 people put in 1,000 ringgit, right? Then you get your 1 million. Is that right? Mathematically? Okay.
Yeah,
Then
I think I
everyone
get.
gets,
Yeah,
then everyone gets the same, what do you call,
percentage.
equity percentage, right?
Okay.
But then some of them could actually give more, right? So one investor could give 100,000 ringgit. Another investor could give 5,000 ringgit, right? So it depends on each investor how much, or rather, what is your risk appetite, right? If your risk appetite is very, very low, right, then you may not want to invest more than what you can afford to, right? But if you really believe in a company, you see this company doing well, you think that by putting in more money, then eventually when I exit, I will then get more money in return, right? So it depends on how much money you put. Based on the amount of money that you invest, then the equity or the shares will be prorated based on the amount of money that you invest in. Yeah.
Right. So let's say I'm an investor and I
Yeah.
invest let's say 1% in this company.
Yeah.
So let's say down the road the company is doing well and 5 years later I wish to sell off my 1%. How
Mm.
can I dispose of my 1% share?
Sure. All right. So there are multiple ways for investors to exit, right? Sometimes it may not even need 5 years for you to do that, right? Again, the quality of your exit depends on when and how the company is performing, right? Say, for example, 6 months after the company had successfully fundraised its campaign on pitchIN, right? The company's shares can now be traded in the secondary market that pitchIN has built, right? So we now run a secondary market called the PSTX, the pitchIN stock trading market, regulated by the Securities Commission, the first ever in Malaysia. So companies who fundraise on pitchIN 6 months after they fundraise, their shares can now be traded on the secondary market publicly. So if Ben, the investor who invested in this company, whose shares are now able to be traded 6 months after the campaign closes, your shares can now be traded. You can then offer to sell your shares at potentially 10%, 20%, 30%, or even 50% of what you bought when they first fundraised, right? Now, if the company is doing well, right, because by the time that 6 months has gone, they probably have done quite numerous cool things which made them grow twice or three times more than what they did previously, right? So me, the seller, getting all this news about this company, I would also then go to the secondary market and then put a bid to buy shares of this company. So when you want to sell and someone wants to bid to buy, then the order gets matched. So that's probably the fastest way Ben, the investor, could invest, right? But your exit could potentially be not as big as what it could be if you stay put in the company, so say for 5 years, then suddenly one big ass company from overseas comes in and wants to acquire the company at, say, 10 times the valuation that you invested. when they fundraise on ECF or pitchIN, right? You're now looking at 10x of your return, right? As compared to say just 20% of an upside of the share price that you bought during the fundraising. So I think the question that we normally ask investors is that you can time your exit accordingly, right? You can do it 6 months after that to the secondary market, provided, of course, the company does well and there are actually people who wants to buy the shares, right? But you could also time it later, right? Meaning that maybe 3 years, 5 years later, when the companies do very, very well, someone else will come in either to acquire them or even a big investor, someone like, again, let's throw some names out, someone like Khazanah, someone like Co-op or EPF who wants to buy the shares of this company, right? And by that time, they're probably valued maybe 20, 30 times of the valuation when they raise funding on pitchIN. You are now looking at that kind of exit, 20, 30x, right? So that's what we say. You got to sort of like know when you want to exit, right? Maybe if you can hold on, then maybe you want to ride it longer, allow the company to actually grow so that you can see a much more bigger exit for yourself.
Okay. So I think the concept is very cool because previously if we want to buy stocks, we have to go to like the public markets and buy the listed company's shares, whereas
That's
now
right,
we can go to like your website, pitchIN to buy like even private companies' shares. So I think that's something very interesting, and it's also regulated. That's
right.
Very important.
For now, Ben, the caveat is that so far only companies who raise funding on pitchIN can do that, right? So we can't really do companies outside of pitchIN for now. But then we do have plans to seek approval to the commission to allow us to also have other companies trading on the platform. So we'll see. But for now, it's only companies who raise funding on pitchIN.
Right. And will investors be able to access their audited financial statements for the past couple of years?
Yes, they will have, right? So right now, if you go to the secondary market and you see a particular counter, say, for example, New Vending, which is a vending machine company, right, doing very, very well. So you go to their counter, you can download, you can also read up in terms of what the latest news and also their latest audited financial statement too, right? Again, we know, and I think you probably appreciate that every investors, their trading depends on information, right? Yeah. Without information, it's difficult for us to actually make a decision whether to buy or sell.
Yep. Okay. Yeah. So in terms of the types of companies that do ECF, is there a certain types of companies that does well, or is it applicable for every type of businesses? Yeah.
So today, after 8 years, Ben, we've seen every type of companies. A lot by law, to raise funding on pitchIN, raise funding, right? Yeah. So it's either companies who are very technology-based, which you can imagine is actually the majority of companies who raise funding on equity crowdfunding. But we now have seen F&B companies, even durian plantations, raising funding on pitchIN. So in the beginning, Ben, it was mainly technology companies, right? Because I think at that time also, founders from the technology space were a bit more familiar with equity crowdfunding, whereas founders from traditional businesses were not that too aware of what equity crowdfunding is. But we're now coming to our 8th year of equity crowdfunding, together with all our other peers in the equity crowdfunding, ecosystem. We've gone out, gave talks, gave workshops, and so forth. And we now see even traditional companies coming to the platform to raise funding. So you'll be surprised, Ben, that one company which has come and fundraised on pitchIN the most times, which is 4 times, is actually a durian plantation company. Right? So every time they came on pitchIN to raise funding, every time they were successful to raise whatever they need to raise, right? So for investors, I think what we like about it right now is that because investors, everyone has their own risk appetite, right? And their own, in terms of interest, right? Some people prefer to invest in something very traditional. So very traditional in this would refer to, say, F&B businesses, right? or agriculture businesses or durian plantation, right? Now, these are potentially lower risk because these companies are a bit more stable, right? They've been around. They can actually show you that they've been around, they are profitable and whatnot, but they need this money to inject growth into the company, right? And most of the time, these companies, Ben, they would offer shares in terms of a preference share or a comfortable preference shares, right? So either at the agreed number of years, Ben, the investor, could exit, right? Or if Ben sees that this company is doing so well, at the year agreed, I can convert to become an ordinary shareholder, right? So these are the type of companies that would offer those kind of deals, right? And for investors who feel that they don't want to take a bigger risk and which they're happy to sit in for 3 to 5 years, then later decide whether I want to get my money back or my capital back plus the upside to my investment, or if I see the company is doing very, very well, maybe I want to ride it out longer with them at that agreed third year or fifth year, depending on the terms. I would then convert to an ordinary shareholder, right? But contrast that then to more technology-based company, right? So you will probably appreciate that technology-based companies. It's difficult for them to actually promise to pay dividend, right? It's actually difficult for them to promise a certain year which they can return back your capital plus some, right? So they'll probably take a longer time. But we all know that for some of these technology companies, although the risk is higher, but the potential returns are really, really high, right? Right now on pitchIN, we have a couple of companies that when they first came on pitchIN and where they are right now, for their investors, some of them are looking at around 10 to 20x, right? Which you normally would not get if you were to invest in a much more stable company, right? So we normally would advise investors, right, to try to diversify their investment. So put some into those more stable companies. The returns are not like wow, but very, very secure and stable, right? Whereas the technology companies, high risk, right? But if we help the companies and also pray, right? then potentially these companies would be able to give us those returns, lah. Yeah.
I think investors probably need to put in money that they don't need at the moment. If they need that money at the moment, then probably just keep it in the bank. That would be safer.
You know, Ben, that's really what I will always tell investors, right? Investing in companies, not just through equity crowdfunding, right? Because I'm sure, Ben, you've been approached by some friends or family members to invest, right? So that's also high risk, right? So people forget ECF is just a platform, right? It's no different from anyone investing in another company outside of the platform. These are privately held companies. These are high-risk investment, right? So you are correctly right. If you cannot afford to lose this money, then put it somewhere safe, like an FD, for example, right? But itulah, FD is FD, not sexy, right? But if you have some money that you think you can afford to lose, again, nobody wants to lose their money, right? But if in worst case scenario, if you lose this money, you still be okay, then yes. These are the type of companies that you should look at. Yeah.
Right. Okay. Interesting. So, I think one final question for like the founders side, lah.
Yeah.
So, what is like the best success stories so far of fundraising via ECF on pitchIN, and like what did the company or the founder did right?
Ben, this is probably a show for itself, right? But since we don't have enough time, right? There are a couple of businesses, Ben, which I really, really want to share with your listeners, right? Examples of good founders and good companies that prepared their fundraising so well that they managed to raise their funding in the shortest time period, right? Because again, like every founder, we want to do this quickly. You do not have 3 months, 6 months, or 1 year of your life to just focus on fundraising, right? So one company that did this very well, actually there are a few companies, but I can share you maybe 3 companies, right? So the first company which I want to give props is kakitangan.com. I think a lot of
Payroll
people
company, right?
the payroll company, right? So a lot of people are familiar with them. A lot of people also use them, right? So when Afen Koo, the founder, came to see us, he was very, very focused in terms of what he wants to do. Already had a game plan, and the fundraising was done very quickly. In fact, when he went live, Ben, he raised the 1.5 million within 24 hours, right?
Wow.
Yeah. So the first 2 months was spent on just speaking to investors, either individually or a group. And he only focuses on other founders who are using his software for their business, right? So Ben, you run your own company. You need a payroll system.
Yeah.
You use Kakitangan. Appen will then speak to you. Okay, Ben, you use my payroll system. You're using it. I see from your usage you love my system. Why don't you also invest in the company, right? So 63 business owners, right, decided to invest in kakitangan.com, and from the original target of 1 million, it was oversubscribed by 500,000, but he closed at 1.5 million within 24 hours. That's kakitangan.com, right? The second company which I like to share is Signature Market. If you're familiar with them, there are snacks, snacks, right? Previously, they were just purely online. You can only buy their products online. Now they have stores in IOI, in Putrajaya. I think they got one in Penang, and they recently set up a store in Jonker Street in Malacca, right? Again, very focused in terms of what they wanted to do. They were facing a good problem, which was they cannot fulfill orders from people, right? So a good problem to have, right? So what they wanted to do was to raise 1.5 million to actually set up a bigger factory, right? To fulfill orders, right? So again, just like Afen, Edwin was very focused. He knew his crowd. In fact, you'll be surprised, Ben, that by far the majority of their investors were actually their users. Yeah, so their own customers were investors.
So they indirectly got a lot of marketers that will tell their friends about the brand.
Precisely, right. So pre-live, they wanted to raise 1.5 million. Pre-live, they raised 1.1 million. When they went live, they wanted to go live for 30 days. But within 10 days, they raised the balance of that 400,000 ringgit. Day 11, we closed the campaign. So again, very, very short time period into the fundraising. The third company, and again, I've got many, many examples, right? But the third company, I would just like to share because this happened during the first ever lockdown during COVID, right? So lockdown happened, we cannot go out and meet investors, so every event was all done through Zoom, right? So this company, Policy Street, maybe you've heard of them, the insurance company, Policy Street. Again, they were oversubscribed. They wanted to raise originally 3 million, but they ended up with 5.2 million within 3 weeks of them going live. And what I like about them is that the three co-founders were very, very diligent in terms of what they do, right? They were like very, very robotic, right? So robotic in a good way, right? So I'm not saying in a bad way or negative way, right? But they were really focused. They did all their sessions very timely, and all the sessions resulted in people wanting to invest in the company. So again, they closed their campaign well before it was supposed to be closed, but they were oversubscribed by 2.2 million ringgit. So these are the three examples. And again, you know what, Ben, it goes back to what I mentioned just now. It's all about preparation, right? It's all about knowing who to approach, your investors, the category and type of investors. And lastly, the valuation works for investors when they came to invest in these three companies.
Okay, got it.
Yeah.
So coming to the end of the podcast. So lastly, before we go, how can companies get started with the pitchIN platform?
Cool. So it's easy, Ben. Right now, companies or founders who wants to explore, right, to raise funding on Equity Crowdfunding, you can just go and register yourself on the platform, right? So it's easy as that. Just open an account. You can add even 2 or 3 of your team members in your company's account. Once you register, I think within a week or two, one of my team members will then reach out to you, right? And that's when we will then have a conversation in terms of us, the team at pitchIN, understanding what your business is doing, right? And again, you do not have to fundraise tomorrow, right? We could plan this out, right? But after you register, someone will definitely reach out to you within a week or two.
Right. Is there like a certain basic criteria? Like, for example, the company needs to be at least 6 months old, or do they need to register a certain Berhad? Is there like certain basic
Yeah,
criteria?
right. So the only basic criteria that is mandated by law, Ben, is that the companies need to be first corporatized in Malaysia. So you need to be set up in Malaysia. That's the first thing. The second thing is that you need to be set up either as a LLP, yeah, Sendiang Berhad, or unlisted Berhad company. So even Berhad companies are allowed to, but you cannot be listed in the Bursa, right? As you know, there are several companies who open up Berhad straight away, right? They also are allowed to raise funding on equity crowdfunding.
Okay,
Yeah.
clear. So yeah, thanks Sam for coming onto the show. Check out
Hey,
pitchIN
no
down below,
problem.
and I'll see you in the next episode.
Thanks, man. Cheers.